Hi everyone, welcome back, and in this video I'm going to be talking to you about the rising costs of mortgage rates and what you can do to really help yourself reduce your anxiety and put yourself in the best possible position when it comes to remortgaging. Now, when writing content for this video, I quickly realised this is by far the most challenging video I've done. If I'm looking down at all, I've actually got notes all around me this time. Hopefully you can forgive that, and without further ado, let's get to it. So I'm going to be explaining what's happening in the mortgage market, why it's important to really think about your mortgage, and share how to start pre-planning, which will really put you in the best possible position when the time comes to remortgage. Now, I do like simple, and as I say, there's a lot of caveats and variables and what ifs, so I've tried to keep things in lists of 3 to keep it easier to understand. And I've also put some timestamps below, so feel free to click through the different sections as you see fit. Quick disclaimer, although I am an independent financial advisor, none of the content in this video should be deemed as advice. This is information only. Any specific advice should always be based on your specific circumstances, and I strongly recommend you speak to a financial advisor before making any decisions or actions. So first things first, why is it really important to think about this? Well, your mortgage and your purchase of your home is usually the biggest investment that you'd ever make in your life. And certainly in the early years and for most of your mortgage term, it's the biggest debt, the biggest expense you have. So any changes in interest rates can massively affect the amount that you pay for your mortgage, and it can have knock-on effects as well. So not only will you not have as much money to do other things that you want to do, so it's going to impact the quality of your life, but it can also affect your mental health as well. So many people are anxious and worried about their finances. So this chart shows the total mortgage lending over time. In 2021, this was just over 315 billion. And this is by far the highest amount that we've borrowed since all the way back to 2007. People are borrowing much more on average compared to 2007 though, due to the increase in house prices too. So the issue of rising rates is affecting a lot of people and a lot of borrowing. So what's been happening in the mortgage market over the past 12 to 18 months? Well, quite simply put, mortgage rates have increased massively. So this is linked to the Bank of England base rate, which for those of you that don't know is the rate that we pay to commercial banks that hold money with us. So banks that are borrowing money are directly linked to the Bank of England base rate. Now, the Bank of England is run by a monetary committee, which their job is to help balance the economy. One of the things they look to do is help keep inflation at around 2%. Now, inflation isn't always a bad thing. Small amounts of inflation is good, but at the moment we're running at nearly 9% inflation, which means that prices are constantly increasing. Now, the Bank of England have raised the base rate record of 13 times in a row, which is the most we've ever seen since records began in 1975. The idea behind increasing the base rate is twofold really. By increasing the cost of borrowing, people will have less disposable income and also be incentivized to save with higher savings rates. So those two things combined should help reduce inflation. However, whilst we have seen a reduction to inflation in the past few months, as I mentioned, it remains at an all-time high of nearly 9%. Swap rates are also at a record high. Swap rates are based on what the markets think the interest rates will do in future. And with record high inflation rates, there's still a lot of panic out there. So swap rates remain very high. So Bank of England base rate, swap rates and high inflation have all created like this perfect storm where mortgage rates are very, very high. If we look at the base rate over time, we'll see a consistent increase since December 2021. Before this date, there were adjustments in the rate. However, there's never been this many increases. Quick side note, you will see here that rates have indeed been much higher than 5%. However, it's important to note that the average house price in comparison with the average wage is far out of proportion to, let's say, the 80s and 90s. Which means people are now spending more than ever on their mortgage as a percentage of their household income. So what steps can you take to really put yourself in the best possible position? Now is the time to start. At the very latest, you want to be planning around 6 months before your current mortgage rate comes to an end. First thing I would do is check when your current mortgage rate comes to an end. You can do this usually online. You may have a current statement which it will tell you, or you can give them a call. Do be prepared to hold a little while. If you are going to contact them, it's also worth finding out when your mortgage anniversary date is and also how much you can overpay. These two things are based on when you first took the mortgage out. Second thing to do is work out your budget. I know it's not the most glamorous thing in the world, but I promise you it will help. So here are two things within that you can really focus on. First of all, it's looking at decreasing your outgoings. Now there's two types of outgoings, broadly speaking. So first up, it's your fixed expenses, things like gas and electric, water, council tax, things that can't change. Then you have your variable expenses, things like Sky, food, going out, entertainment, things like that. The way to reduce this spending is to ask for a reduction first and then look at switching packages and cancelling what you don't need. The thing that almost no one talks about is actually the idea of increasing your income. I know it's not that easy if you're employed to just walk in and ask for a pay rise, but if you feel awkward about talking about money with your employer, it might be worth switching the focus a little bit. Rather than talking about money, talk about your development and how you can add more value and how you can ask for more responsibility. Off the back of that will be the money conversation, but hopefully that's an easier starting point. If you're self-employed, look at how much money you're charging your clients. I'm not saying it's the right thing just to hike your prices up for every client overnight, but a lot of people that run their own business haven't reviewed what they're charging for at least a couple of years. By having this overview, you can see the areas in which you're earning most money, and therefore those are of course the ones you want to focus on. The next thing to mention is overpay as soon as you can, if you can. You can do this in two ways. One way is paying individual payments on an ad hoc basis. Second way is by adjusting your direct debit so that every month you have an increased amount coming out. Now, overpayments will help reduce the overall interest that you're paying on your mortgage. Even by paying small amounts, it can really make a difference on a long-term basis. Now, some lenders have what's called an overpayment pot, which is a separate pot of money, which means in future, if you struggle to pay your mortgage payments, you can dip into that overpayment pot in order to make partial payments. Now, if you're adjusting your direct debit, I'd say there's a psychological benefit in terms of having a higher committed expenditure each month. So for example, if you have 2 years remaining and you make an overpayment of £150 a month, that amounts to £3,600 over the next 2 years. Now, not only will you save more than that because of the interest that you save, you're also committing to a higher payment. So if your new payments are £300 a month more, you're already bridging that gap by paying £150 more in the first place. Now, there are a couple of caveats here. There's so many variables to consider, but the first one would be if you have a lot of debts in the background that are perhaps higher than your interest rate for your mortgage, it would be advisable to pay them off first because you're going to save more interest. And also make sure that you get the right advice in terms of adjusting your direct debit because it's a longer term consideration and you want to make sure it's affordable, not only in the easy months, but also in the more expensive months as well. And the final thing to mention within this video is try to speak with an advisor as soon as possible. Now, I've done a separate video here about the reasons why you would or wouldn't consider using a financial advisor. However, for the purposes of this video, I would strongly recommend you do. A financial advisor will not only help you find the best rate possible, they'd also help in the overall planning process, and they have lots of experience, particularly recently, at how to plan around the mortgage markets. Now, when finding a mortgage advisor, there's three things to consider. Now, you want to make sure that they are an independent and whole of market mortgage advisor, and you'd also want to ask how many lenders can they access, because being whole of market might only mean that they can access 60 or 70 lenders. That might sound like a lot, but there's nearly 150 in the UK alone. Now, in the next video, I'll be continuing to share practical tips at how you can really put yourself in the best position possible. Thank you very much for watching. Appreciate you sticking with me for a very in-depth topic. Please feel free to subscribe and turn your notifications on to see the next video and all the videos after that. Hope you have a great day and stay mindful.